Hi, everyone. Patrick, Brand, everyone doing okay?
Hey,
Hi, Steve. How are you?
what's
There,
up? What's up with your voice?
there's a shortage of NyQuil. There's a bull market in NyQuil here in California. Do you know what NyQuil is?
No, I was about to say I have no idea what that is. Sorry.
It's like that liquid flu stuff you take. It has everything in it.
Ah,
So,
okay.
yeah. Okay, so you taking any like huge, large positions into Wednesday, Steve? I know it's your style to.
Absolutely not.
Okay, that's what I thought. So, what do you do? What do we talk about?
Getting ready, preparing.
We
Okay.
talk about, yes, exactly. How we prepare.
Okay.
What are the
How?
chances ahead of the Fed?
Okay. How are you preparing?
Now, of course, it depends
And
on the trading
okay, let
style, but I have to say that from a risk reward perspective, I do see opportunities in the direction of the Fed disappointing, so dollar strengthening, equities moving lower. If that's what happens, I think some markets are very nicely positioned ahead of that.
okay, so do you do it ahead of it? Do you get long dollar ahead of it?
There are several pairs that have an excellent risk reward opportunity. So obviously it is a risk, but it will be a limited risk. So I don't think it's necessarily a bad idea as
So
long
could
as
you
people
buy Dixie here and risk the lows?
that is a possibility.
Okay.
Um,
Could you sell the S&Ps here
the
and
S&P
risk
seems to
last
be
week's
just
high?
the S&P seems to just be consolidating the recent lows. It looks to me like it's extremely likely to produce another leg lower following the Fed.
Okay. All right. And that's what I'm saying. So Ryan, tell me about
The cable is at resistance. The
yes.
euro is likely crafting some kind of an ascending wedge. In general, I see several markets that look good uh, post Fed if the Fed disappoints, which I think is a high probability scenario.
Okay. And you're talking about the language in the press conference after
I'm
the
talking about
50%.
I don't think that people will get out of the Fed anything they like other than the obvious and well communicated slowing down in rate increase thing. But other than that, I don't think they're going to get anything they want out of it.
Okay. Okay. Ryan, why don't you tell us about your preparation?
Yeah, pretty. We've been saying so much on the flow show this morning. You've got to look at two aspects: what happens this week and how we finish this week in price levels, because that's really what takes you into 2023. The next week and the Christmas days, etc. That can be a complete lottery of year end stuff. So yeah, I'm in positions, as you know. I'm short dollar versus the Aussie. I've got a little bit of dollar yen on short. I'm looking to either build on those positions, or if the Fed does turn a bit more hawkish, or Powell, pushes the envelope of what they're going to do with rates, and we see a bounce in yields on the dollar, then I'm going to look to add to my shorts.
Where?
Dollar yen. If we
Yeah.
get a run into 138s, 139s, maybe even 140s, if we get that high, that'll be
Oh,
looking very juicy.
okay. Yeah,
And
that looks possible.
yeah, and
Okay.
Aussie dollar. It's like Steve was saying, we're on some big levels. If we can see Aussie dollar closing this week above 68, even better 68.50, that's going to look bullish going into the new year. Euro dollar, another key level. 106. We've had a couple of goes now. If we can break that and hold it into the week, that sets that up for a bullish run early 23. If we can't, though, it means a lot of hard work still to be done, I think. And I wouldn't be surprised if we saw, those pairs like that selling off over the year end stuff.
Okay. Came in around?
Hello, Dale. Hello,
Hi.
everybody.
Hey, Iceman. How are you preparing for the next couple days?
Well, I agree with Steve, and I said as much on the Flow show. Powell may fight back a little bit about against those easing financial conditions, and in that respect, disappoint the market a bit. I still think the dollar isn't dead yet, yeah, I'm more looking at the upside dollar than the downside right here and now.
Okay.
For the Fed at least. Yeah, I was looking at options in dollar yen, but they are still far too expensive. So I'm just in faster stuff and trying to perhaps keep a little long in dollar yen, for instance. But also as already mentioned, euro dollar interesting zone up at the one around the 106, cable 123 and above. Yeah, those are candidates. Aussie dollar perhaps as well around 68. There's decent levels there to pay attention to at least.
I just noticed this as I was, running through things that the 10-year yield certainly looks like you could be developing a right shoulder here, which if we break out would give you 380 on the
Yeah,
10-year.
Which would not be excessive if you take into account that the Fed is going to had at 50 bps, which is of course more reflected in the short term. The longer end is more about expectations, and which could move quite a bit tomorrow on the CPI. So we have
That would just be a correction of the recent decline in yields.
Yeah,
Anyway,
absolutely.
that looks interesting. So that should be dollar supportive.
For in at least in the short run, that's what I think, which is a fair possibility.
Okay, I was looking at copper, and we have two drives here. So I don't know if we're going to have three. It'd be interesting if we had three back to major resistance up here. But I don't know. This looks like this could be turning into a failing rally. Which
the whole
would tie.
move from the July low to what we have at the moment is within a channel and looks corrective. So copper, in my opinion, is a very good risk reward short from roughly these levels. Plus, we're currently testing that channel's resistance. We're currently testing the 200 daily moving average.
Yeah, see it.
We're currently testing the 38.2 from the what was it, February high, March high, something like that. I think March high.
Yeah.
Copper is another market that from a risk reward perspective has a very clear direction at the moment.
Yeah, I mean, this looked very impulsive and this looks corrective, right? So it's just a question of getting your spot. All right. I'm still buying WTI. So I know everyone's looking for 68, 65.
WTI on Friday reached
70, 10.
Reached the target of confluences we had. First of all, it completed the double top that we formed in October and November. We had a double top. One high was in October, one in November. That created a double top. And the completion was exactly there. Second of all, it reached the 50% fib from this whole move higher, from the lows, we're talking about the continuous, to the 131 highs. And it's also the 88.6% fib from the December, last year's December low to this year's high. So nice triple confluence of supports. So obviously a very good level to try to buy. Although, as always, since we are now in a move lower that has persisted for quite some time, I always prefer to get more evidence
You'd
than
rather
just
buy strength.
than just reaching a very nice confluence of supports. Nevertheless, I want to see more than just stalling here, right? Other people, of course, are more aggressive. They attempt to buy a lot earlier, and they have a better entry if that works out. It's a matter of preference. Personally, I'd rather miss, the beginning of the move and be more confident than, jump heads on and be wrong.
Well, what do you think, Dale? Are you just buying the level down here because it's holding, or you're sticking it more in your own SPR, the Stop Hunter Petroleum Reserves?
Oh yeah, I have one of those. In fact, I don't know. I went out to get something to eat, and I was almost on empty. So I like it based on, first of all, it's been such a huge bear market for such a long time. No one likes it now. And if you notice the RSI action here on multiple time frames at the recent low is now diverging. Mm-hmm. I think it's just set up for, at least a squeeze back to 76. So I like the profit risk ratio here. I'm risking a couple bucks from where I bought it this morning, and I think there's 4 or 5 in it.
Cool.
A little 3 drive to a bottom too. If you go out a little bit. The telescope here's, pretty classic 1, 2, 3. And mm-hmm. within the third one, on the third drive, you have a 3. So a smaller fractal of what I showed you a longer term. So yeah, it's a kind of thing that I say, would you be short down here? And no. So yeah. I think it's a decent shot.
Agreed.
I don't know if that's going to help the S&Ps or not. I was looking at Apple. Apple's 8% of the market, and it's not really too bullish of a formation. It's like a descending triangle. I thought we might break down last week before we recovered on Friday, but under 140.5 is a breakdown in Apple. That could take it down to 130 or lower. I don't think that's going to be bullish for the market. But, on the other hand, I look at things like the semis, and I think a break would be healthy. I think, because, if we're getting a pullback in bonds, they're the most sensitive. So let's just say we're getting a pullback. This wave has completed. And TLT was a heck of a wave, right? From 93 to 110. And we pull back to par. That maybe that's going to be a real nice acid test for the market and the dollar and interest-sensitive stocks, which, I like the semis if that happens, even though I can't. Oh, here we go. So I was thinking, I was talking about this last week, how we were kind of stalling up here. And, if we had a pullback in the semis, back into this range, I think they're a buy. So I'm hoping Steve's right. S&P sell off, and I have a shopping list.
Yeah, I like charts like that because you've got a definitive high and a definitive low, at least in the short term. So you got a break trade possibility both sides.
Yeah, and the Russell kind of looks like that too, which has been lagging. So I think that if Steve's right and we get a nice break, a week ago, I thought the S&Ps might really flush to down here. I don't know if they're going to do that, but maybe 38.5 or so after the Fed. I don't know if we're really going to get crushed. But what the heck?
You never know. You never know this time of year.
Yeah. So, not doing much until after Wednesday. Crude, for some reason, I don't worry about what the numbers are going to be. I think most of the bearish news is out. And I don't think they're going to give President Biden his price to fill up the SPR.
So can I ask you something as well? Because we got this debt talk as well happening this week. Friday's the deadline for fixing the government funding through this next quarter into the new year. Is there any big risk coming from that, do you think? Or are they just going to do the usual mini can kick on Friday afternoon before the close.
You know, who knows? Yeah, I mean, I'd say that the market's complacent about it. So, you know, everyone's expecting exactly what you said. If that doesn't happen, that could be, you know, a negative. Anyway, Canada, you know, it's been kind of a, you know, trading to a beat of a different drummer. This 37 area looks big. If we could get through it, maybe we're looking at new highs in Canada up towards 40, 41.
Yep.
Or would you sell it here? I mean, it worked last week for scalps anyway, after the BOC came off. But again, it held again. It's like a beach ball.
Yeah, we get to we have the moves, we have reversals, and they just get to the levels, and they're not huge levels in the longest standing, but short term, you know, like you say, you get up to 137 and you start banging your head again.
Yeah.
And the same question you said with oil, would you buy it at 137 at the moment? Probably not.
Silver looks great, but we are starting to diverge between these two highs, and 22 still the line in the sand. Just, you know, if you believe stocks lead metals, the performance by, you know, best of breed would be what, Newmont, and it doesn't look great to me. GDX looks better.
Good morning, Dale. I
Good
hope
morning,
you feel
bro.
better.
Thanks, Blake.
You sound horrible. I figure I'm going to save you right now. So.
Oh my gosh, you're my hero.
So you know, you were just talking about silver. Yeah, a lot of divergence in the in relative strength there, and you know, I know you were just talking about crude, and this is what Steve was talking about, like the confluence of crude. You know, we have this 127% extension of, this is the, I guess, the move of all fall, then 127% extension right there. Then there's a 50% retracement of the entire move that Steve's talking about. But it's hard to really gauge this, because, you know, where do you mark up the lows? Like, you don't, you know, like, it depends on what feed you're going from, and, you know, what futures contract and whatnot. But there are, you know, as far as the other confluence, there's a lot of confluence here. And as you were pointing out, there's, you know, nice little setup in crude oil. But going back to precious metals, what you were just talking about, I'm struggling because silver is really struggling to make highs. And then we have, and you can see as silver makes new highs, the relative strength is divergent. And then we have CPI data tomorrow, and then the FOMC, you know, on Wednesday. So I want to ask you guys, the team, this, what do you think is going to be the bigger mover this week? Is it going to be CPI tomorrow, or is it going to be the Fed on Wednesday? It
depends on what we get from the CPI, Blake.
I'm sorry.
Totally depends.
I was going to ask everybody but Steve. Just kidding, Steve. Go ahead.
It totally depends on what the CPI comes to be. If the CPI, for example, surprises to the upside, which is not a very likely probability in this case, but if it does, it can actually get people pricing in advance a disappointment from the Fed, right? Now, if the CPI does not surprise to the upside and comes more or less in line, or even a little bit weaker than expected, then in my opinion, there is a huge probability that the Fed is going to end up being the big mover for the week.
Yeah, I'm still a believer that the CPI is going to be the mover. It's going to be tomorrow. It's going to be more than anything. But
it might be, but depends on how it comes out. As I said, if it comes in line, for example, it won't.
So, K-Man, what do you think?
Between CPI and the Fed, you mean?
Yeah.
Yeah. Well, as I said, to be perfectly honest with you, I think that real data will matter more than the CPI. I think CPI base case, it's on a gentle slide lower, let's put it that way. So the surprise would be a higher one, and personally think that Fed Powell is going to disappoint a bit. So yeah, whether it's going to be a bigger move, yeah, it depends how far from expectations it comes out, that CPI.
All right, Ryan, what say you?
Yeah, no, I agree. I think there's potentially bigger risks elsewhere. I think if you look at something we were talking on the flow show, look at something like the S&B market's only pricing a 50 and a 25, and I think they could go with 75. I think the same risk for the ECB, pricing the 50 and 25s. Sorry, 50 and 75s. I think there's potential for a bigger risk of a 75 than the market expects from a 50.
Wow.
So.
Wow.
Yeah.
Now let's hear from Stelios. Do you think that the ECB's got? Do you think Christine Lagarde's got that in her?
I don't think so. She's always disappointing. But
I mean, Ryan, you got to ask a European. You can't.
Not an Englishman.
Not an Englishman. Yeah.
But I was going to say, regarding your other question, I think CPI is going to be mega important. Very important. Yeah. So obviously it's the Fed decision, because that's going to be the event of the week, because they're going to potentially guide us to where the peak is going to be and how long it might stay there.
I'm with you, Stel, because it's going to tell us whether we're going to get a quarter in 2023 or 50 in 2023.
No, and not just that. I think they might give us an indication on where, or the market might translate that into how long the plateau is going to be. Because at the moment, remember, we're pricing 2 or 3 months, and then we're starting to cut. So a few well-placed words or phrases, and that might become the rest of 2023 being flat rates. And then they cut.
Here's another thing, you guys. And this is what I think is going to completely derail the market next year. And this is, I'm doing a special with Chris Weston later this week. And by the way, anyway, I don't need to talk about this right now. As far as I was going to mention something else, but I am talking with Chris Weston this week about like expectations of 2023. And personally, I feel like one of the biggest risks for the markets next year is that everybody's expecting rates to come back down. Like everybody thinks the Fed is like the same old Fed. And I think they're going to hold rates stubbornly high. I don't think that unless there's a shock, there's an actual shock, like, I don't know, the markets just absolutely collapse because Russia's, starts attacking different parts of Eastern Europe, and you're like, whoa, something like that. And then the market really, the markets, react negatively, and they have to react with a rate cut. I think rate hikes are going to stay high for longer. And I think the market's really starting to price in rate cuts. What do you guys think? Do you think the Fed is liable to cut rates quickly?
No.
What's Brian? Was that you?
Yeah. No, I don't think they are.
You don't think they are either? See, I think that's a big risk going into next year.
I think the market's going to price that, but we were saying on the flow show, what happens if inflation gets down to 4.5%, 5%? Still well above Fed target, but they're in a big recession. Jobs are dropping, unemployment's rising, all the bad economic stuff's happening, but inflation's still high. Are they going to cut rates into that? Can they?
Right.
I think the question we have to ask ourselves is, what do we think needs to happen for them to cut? Where does inflation need to go for them to cut? That's a question. Yeah. And I think that number has to be well below 2%, obviously. So how likely do we think this is it for to happen?
I'm not sure they're going to wait for below 2%, Stelio, but definitely they're not going to be cutting seriously unless inflation surpasses rates to the downside and keeps being in a downward trend.
Yeah.
Right. So I wouldn't be surprised. Let's say we top up at 5% yields, right? And inflation goes through 5% and gets, let's say, to 4%, and the trend is still downwards. They might slowly start cutting, but I don't think they're going to cut to bring rates below inflation again until inflation reaches, the target and stays there. So, yeah, I don't think that it's going to happen as fast as the market expects.
They're only going to cut rates if there's a financial accident or, some type of
there has to be a catalyst,
systemic thing.
Yeah, there's got to be like that black swan type of event.
There is a precedent for what they could do, Blake. If you just look at the 70s, the Fed paused hiking, I think at least 3 times, and then had to start raising rates again. I don't think they went to easing. They just stopped raising rates for a while, and then they saw the job wasn't done. The monster was still out there, and they had to start another tightening campaign from higher levels. And that could roil the market, is they pause, or the market perceives a pause, and then they start raising rates again in the spring.
Yeah, it's hard for me to see that that inflation is just going to completely reverse, and we get some deflationary pressures that take inflation all the way back down. I don't see it.
Unless the job market collapses.
What's that?
Unless the job market collapses.
Yeah.
Because that's the last big domino for me. I mean, if the job market starts to look ugly, then they are going to be much more attentive to it, and they will pay then much more attention to also the combination of inflation and the job market. But
how about China? And I'm going to ask you guys, what do you think about China, and if China just starts like trying to come online too quickly, and does that provide a deflationary headwind, or is it inflationary? What are your guys' thoughts?
Originally inflationary, right? Because they are going to buy lots of stuff if they do it, because now they are trying to reopen, and but
depends on the product, because
people
it's both
just, stay at home because they are ill anyway. So
depends on the product and the industry. I mean,
right.
For products that during this whole period have been in short supply, reopening China can be actually deflationary for the cost of these products, but having to do with inputs, right? I mean, materials, etc., inflationary.
Yeah, Tony, everyone says China's uninvestable. It's very tradable. I know guys that are making a lot of money being long China for the last couple months.
Oh man,
it's
been just the ETFs have gone freaking nuts.
So people say it's uninvestable because they didn't have they had too much fear to buy it when it was right. So I understand that. You rationalize something you don't do, but it is tradable.
Yeah. I think Dale, that investing in China requires one of the two following things: either a real knowledge of what's happening on the ground, which I don't have, and the vast majority of people don't have.
Yeah.
No, there are people that do have a good idea, but they're a very limited number of people, right?
Xi knows everything there,
and or a very, very high tolerance for risk.
Yeah.
Well, listen, Dale's gonna have an interview here in just a bit. I want to.
Dana?
What's that?
Yeah, I'm looking for Dana. Dana.
Okay.
All right. Sorry.
Is Dana here?
I don't see him yet.
Oh, I'm sure Dana will be up here in just a second.
Forex guest hunter.
Yeah, he is. He's always he's a guest quite frequently here on the F.A.C.E show. But before we go, I just want to say that tomorrow, in my opinion, tomorrow's going to be a big day, and it's going to be a huge day in the market. Today might be kind of quiet, and we're going to be developing the bias chart with the ForexAnalytix crew here in about 45 minutes. So if you're a ForexAnalytix subscriber, make sure you're here. But make sure you're here tomorrow, because tomorrow we'll just kind of get you set up for the CPI. Then we're going to go through it live tomorrow. So it's going to be a big session tomorrow here on the F.A.C.E show, and I think it's going to be a big one. And then after that, we're going to have to start thinking about what the Fed's going to do, and that's going to be our next conversation Wednesday morning at this time. So Dale, did you find Dana?
Not yet.
Oh, okay. Well, let's see. I don't.
Dana, if you're here, instant message me.
Raise your hand.
Yeah.
Let us know.
No, actually, I'm not kidding. There is a raise hand function.
There is.
Yeah, there is, but everybody decides to
There's
do it
one that gives the finger.
Simon raised his hand, for example. No surprise there.
Look out! Hey, what do you guys think here? I mean, and while Dale's looking for Dana, I gotta say that man, I think this Sterling's set up for a big breakout, man.
Yeah.
What do you guys think about that? I mean, if the Fed, let's say CPI comes in weak, and let's say the Fed comes in a little bit less hawkish, I mean, this Sterling could be trading up at 128 pretty quick. Right, it could do one of these really fast.
On the other hand, the head of the Fed, from a risk reward perspective, it's nicely positioned to reverse lower.
Of course, but I'm just saying.
I was going to say this is the pair that I like. If somebody thinks that the Fed is going to be hawkish, this is the pair that I want to be short.
Yeah, it looks very good. It looks very good.
Yeah, I mean, it is set up so well to be bullish, and that I mean, it looks like it really wants to rip some heads off if we get a dovish Fed.
So orderly, and every sell-off so shallow.
Yeah, I mean, look at the 200-day moving average, just holding it like it just holding it nicely. Now, obviously,
although following the weekend and the World Cup, it should have gapped down, right?
Yeah, exactly. Because and dude, I gotta ask this, just because for you guys in the UK. I mean, I couldn't believe Harry Kane. I mean, I know no one else can, but it's like, what happens when he comes home? Is he gonna be like people going to throw things at him?
Why, mate?
He missed that PK.
Mate, scoring penalties is not as easy as people think on television, right?
I do it all the time on my kids.
Statistically speaking, especially when the ball is hot, the percentage.
Steve, I don't want to go into mechanics of football here. I was just asking really a question. If he's going to get thrown, people are going to is he going to get a lot of hate?
One of his teammates said we would not have been here without him when asked that question.
That is actually probably the more realistic approach.
Yeah.
Is he going to get a lot of hate when he gets back to the UK?
Yes.
Okay, Ryan, you think so?
Yeah.
Man. All right.
That would be totally unfair.
Did Dana get here?
No.
Wow.
Twice in a row.
That's weird. Yeah. All right.
Okay.
Well, here we are. I guess we're going to catch all the ForexAnalytix folks in about 45 minutes. Steve, aside from football strategy, do you have anything that you want to leave all the traders with?
No, I think I was very vocal today, so I gave my thoughts on practically everything. Of course, we're going to go into detail on different markets on the morning edge, as we do on a daily basis, right?
Right.
Stelios,
any last minute thoughts for the folks here on the F.A.C.E show?
I'm going to say what I said on the Flow show. I think the chances are rising for the Fed to disappoint. So if you want to be long the dollar, I'd probably pick the pound, as I said. Now, if you think the other way, if you think they're going to be either as expected or more dovish, well, I'm already long silver. I started accumulating a while ago. People on the chat room will know this. It's nicely green at the moment. I think that's, metals is the way to go. Still, gold above 1800, and silver, platinum, pick whatever you like. I think they're all going up.
All right.
And if they have tolerance for a little bit more risk.
Oh, hey, Dana's here.
The miners are also
Forex guest hunter.
All right,
Excellent.
way to go, Dale. Look, good. We're good. Good. All right.
All right.
Hey, you know, K-Man, Ryan, we're gonna hear your ideas in the chat room. Of course, make sure you guys check out the trader funding program if you haven't figured out how to get involved in the ForexAnalytix community. This is like actually included as you're going through the assessment, because we want you guys to have ideas, have people to talk to, whether it's myself or the rest of the team. So make sure you check out the trader funding program. Watch this 2-minute video. It's really easy to understand how it all works once you watch that video. Dale, have a great interview with Dana, and thanks everybody. Thanks, team.
All right,
Bye
thank you,
all.
team. All right, guys. See you later. Dana, I know Monday mornings are tough for you. Appreciate you being here. How are you?
Oh, you got it. Hey, Dale. Sorry,
Almost forgot again. Huh?
Yeah, no. No,
All right.
I just I couldn't connect for some reason, but
I was gonna
I'm
send
here.
the Twitter hitman after you.
Yeah,
If
no,
you didn't show.
I'm
Anyway.
here. It just wouldn't let me connect, but I'm here.
All right.
So,
Well, big
nice to talk to you.
week ahead, Dana. Big
Yes,
week.
sir.
You want to show your screen and kind of tell us what's front of mind for you going into the CPI and the Fed. Are you positioned? Are you lightening up in front of it?
Yes, sir.
What sectors do you like? And you know, are you bullish or bearish? You know, that trend line, Dana. I want to start with this. You know, the universal downtrend line.
Right.
That even people on Mars are watching.
Right.
From
So
the
you're talking about
all-time
the
high.
S&P? Yeah, you're
Yeah.
talking about the S&P.
Yeah.
Right.
Isn't
Yeah,
that
I
too,
mean,
isn't that too pat?
yeah, it's never you know how it goes. It's never that obvious, right?
Yeah.
Which is, you know, it's this such a benefit to the instant widespread information, widespread distribution of information, and
Right.
dissemination of information. But that's it's also a curse because everybody knows everything now, which is why some of the traditional things that have worked well in the past, they don't work anymore. You know, so I look at a lot of breakouts that you know, it's not like it used to be. Now
You can't trust them.
breakouts tend to fail, and
Yeah.
breakdowns tend to fail, you know, at least initially. At least they're head fakes. They shake you out, and then maybe they work, you know. So but the obvious things don't tend to work anymore, and it's the same thing with a lot of, you know, stats. You know us, we're all into the quants and the stats and the data.
Yeah.
That's the most important
ratios.
thing. But and some of that, a lot of that is still useful, but some of the, you know, like the trivial stats, like you know, 10 out of 11 times historically this has worked out. Those types of things are not as reliable or consistent anymore.
Like Santa Claus rally.
Because, including that. But I don't. Some of the seasonal stuff has a lot of history to it, and there are certain certainly seasonal factors that there are reasons why some things do work consistently over time. So there are gentle headwinds and tailwinds to some of those seasonal factors, but certainly once those things become more widespread and well known, they stop working as well. I do have one what do I do? A new share. One reason, one bullish, I should say.
Breath. There was a breath thrust or something.
I'm trying to get a different.
All right, so you stop sharing and
on.
then you new share.
A new share.
Anyway, while you're trying to figure it out,
yeah,
I wanted to ask this. This is you know, kind of consensus narrative that the lows haven't been made, that we're going to make one more, we're going to have a flush into the first quarter to take the S&Ps down to 3,100, the pre-COVID high. A lot of people using that narrative. Are you in that camp or not?
We're definitely in the camp that we're going to new lows eventually. We do think this is a bear market. No, I finally figured it
Okay.
out. So sorry. Here, so on the bullish side, okay, you
All right.
have bullish seasonality, right? So this is the presidential cycle, the 4-year presidential cycle. So we have like 3 of the best quarters, including the current quarter of the whole 4-year presidential cycle. We
Coming up?
basically started that run, you know, so we're in the middle.
Okay.
We're in the middle of the first one. Okay, so seasonally speaking, this is the most bullish time of the whole, you know, 4-year presidential
So
cycle.
we could be
So
good till
that-
the spring?
yeah, that
according to
takes us
this?
through. That takes us through the first half of next year.
I
So
know a
that
lot of
is
people-
one.
yeah.
That's one bullish factor, but certainly that, like I said, seasonality is kind of a gentle breeze in your face or at your back. It certainly pales in comparison to, for example, some the macro environment and the technical environment. So that would not be obviously the reason why we direct our, you know, investments. For us, we have a technical or quantitative model that it's all data-based, it's all data from the market. It has a heavy bent on breadth statistics, on money flow statistics. So that's going to direct our investment.
Wasn't there recently a very positive breadth thrust?
There, you know what? Looking back in let me get this, move this out. You know, you had in the summer.
Yeah.
And that's another thing that said, okay, you know, every time you've had this breadth thrust in the past, we've gone on to new highs. Guess what? That failed. You also had, you know, back here in July, in that June to August rally, every time we've recovered more than half, 50% of the downtrend, we've gone on to new highs. Guess what? That failed instantly too. So those types of things are not working as much anymore. I will say, you asked me if how we're positioned, if we're bullish or bearish. Our risk model did give a buy signal in the latter half of October. Had some strong breadth readings off of that low, like you mentioned. It's still on a buy signal, so our bias is still to the upside. Our signals, those signals tend to last 2 to 6 months. So right now, our bias is still to the upside, but as you can see by the chart of the S&P, the biggest headwind right now is simply, you know, to the technical picture. We've got plenty of resistance to work through on the S&P and other areas of the market, especially the growth sector, the NASDAQ, tech sector. Those they have tons of resistance to work through if we were, for example, going to go make a run at the old highs. So technically, we have a lot of challenges. From a breadth perspective, from our quantitative perspective, again, the benefit of the doubt still to the upside, but our indicators are even slowing down and not showing that momentum that they used to. But here's one, the equal weight S&P 500. So this index, this look at the market is more correlated to our risk model, to our quantitative model. And you can see how much stronger it is technically than the S&P, than the cap weighted S&P. So this ticker symbol is RSP on this ETF. So sitting above most levels of key technical levels of support, sitting right on that 200-day average. Some short-term Fibonacci support did fail right at that 61 retracement from the highs. So again, this look has some technical challenges as well, but better position as those breadth statistics would have suggested. So this one area of the market, obviously, that is a little bit better positioned and is a better tell for the overall market. You know, there are how many tens of thousands of ETFs or investment, you know, vehicles out there. You don't have to always be invested in the S&P 500, which is, you know, one of our, you know, one of our 2 tenets of our investment philosophy. Is the overall market going up? If it is, then where do you want to be invested? And we want to be invested in the strongest areas of the market. We don't want to be diversified across all areas. We want to be heavily concentrated in those areas of the market that are working best. So you find those areas of the market that are technically better positioned, like this one.
All right. How about since we last talked, there's been a shift in direction in the dollar in a fairly big way, 10 big figs.
Yeah.
From the all-time high. Do you believe this is a trend change, and should we look at that as a positive for risk? It used to be. Do you think it still would be if that continues?
It has been for the last couple of months, obviously. So if you're into that kind of intermarket analysis, that would be probably a positive. But again, those types of correlations, correlative investment, they work until they don't. Sometimes gold and the dollar go in the same direction. It's not reliable. Our philosophy is it's hard enough, or our thinking is it's hard enough to figure out the direction of one market, let alone figure out the direction of a market based on the direction of a different market. You know what I mean?
Did your stuff get you
long?
Know what I mean? Yeah. Did your stuff get you long miners? They came to life over the last few months.
We have a long position on miners. Our bias is certainly to the upside now in the precious metals complex. But you asked about the dollar. I think overall the major trend is still higher. Obviously, in the intermediate term, the shorter term, the trend is lower. I would say we started buying some more dollar or in the last week or so. You can see, we're outside of our quantitative model. We use some charting techniques for entry and exit positions, and we do rely quite a bit on Fibonacci levels. And what we like to see is kind of a cluster, a confluence of Fibonacci levels line up in the same area. So if you go back to the lows, the dollar low in 2008, that 23 retracement was the first key Fibonacci level to look at. We're testing that level right now. It also lines up with the 38 retracement from the COVID low, or the 2020 low, right in this general vicinity. So around this 104 to 105 level, I think is important support. So we've been buying the dollar for a counter trend move. Certainly, it's got some. If we get up towards that 109, 110 level, it's got some resistance to get through right there. But for a trade, definitely that's a position we've been buying over the last few days as we've tested some support.
Okay.
So, yeah.
What about, are you a believer in this the long end of the market, the bond in yields, the bond market, TLTs had one heck of a run.
Yeah.
Would you buy like a 50% retracement in bonds if it happened?
Okay. So long term, and we've talked about this, I think, in the past, long term, we think interest rates have bottomed in that long. There's about a 60-year interest rate cycle. We think that bottomed in 2020. So we think interest rates go up for a couple decades. Nothing goes up in a straight line. So if you scroll back again, here's the 10-year yield from the top in 1981. That first Fibonacci level would be that 23 retracement, again around that 4%, 415 level. So we were short bonds most of the year.
Yeah.
Rallied up, hit that first key level, just above 4%. So we did go long. We're still long for a trade. We did sell a lot of our long position as we pulled back and hit the first, that 23% from the COVID lows of 2020. So right around that 340 level, bounced perfectly off there. So we did sell a lot of our long position there. Have not flipped short just because the short-term momentum is down still in yield, but we'll be looking at another test of it. Might flip short. Best case scenario, I think maybe rates pull back to about that 280 level, and then the trend reverses higher again. So if you do, if you're looking to get a mortgage and you get that 280 level in the 10-year, I think you lock that in, because that might be the best rate you see, at least in my lifetime.
Okay. Great advice. Okay.
Yeah, I would see, despite I mentioned earlier that, eventually I think we do go to new lows in the market. And I think we're in the longer term, I think we're in big trouble just because of the macro excesses in the market, which have hardly, here, I got a couple charts for you. So from a long-term perspective, there are a lot of excesses that have been built up in the system that are not going to be, kind of worked off real quickly. So here's one, is the household stock investment. So this obviously goes as a long-term chart. So in the blue line tells you how much households have in stocks. And recently you can see at the start of the year, we went to an all-time record above that 40% level. And based on that, the forward returns in the S&P have not been good. The red line is inverted. So every time we've gone to a peak in household investment, the forward 10-year return has gone to about zero or even negative at times. So if history is any guide, we're up in the range where, where S&P is negative or basically unchanged over the next 10 years. So there's a lot of excesses to be built out there. And then you go to the Buffett indicator as well. It shows a similar story. Market cap to GDP, he likes to look at, and has made that indicator kind of popular. So again, we went to kind of
the sky,
point where market cap has doubled GDP, which the previous record was 2000, which was about 150%. And we have pulled back this year during this pullback, but only back down to about those 2000 levels. So we're only back down to the previous record. So from a long-term perspective, a secular perspective, we think we're in trouble for the next perhaps decade in terms of stock investment. And if you look at the bond market too, the charts that we just looked at, you look at a 60-40 portfolio, that's in trouble too. If the bond market is going to be, it is in a long-term bear market as well. So it could be we think it's going to be a very difficult environment for stock and bond investors. So
is it a time you like the dollar, yields are going up? Is it the time for people just to sit in the dollars and 90-day T-bills and just collect safe money returns?
Yeah, I mean, there are long periods where two things, there are long periods where, they say it's more important the return of your capital than return on your capital. And this will be one of those environments. And then the second thing is that it's not like there won't be big opportunities along the way. Again, nothing goes in a straight line. These bear market rallies are explosive. Even the counter trend moves in the bond market, like we're seeing now, the counter moves in the dollar, like we're seeing right now. So I think either you sit in something where you're not going to lose money, or you find, and this might be the wrong crowd I'm talking to, because you guys are probably believers in an active risk managed strategy. There's no buy and hold, there's no passive investment. But for 99% of the population, they need to find someone that does manage tactical. They manage risk. It's not always buy and hold. There are opportunities both ways. Find someone that will move your money around to at least try to capture some of those the bigger trends, if you're not not in there day trading or anything like that, but manage risk and try to capitalize on some of those opportunities along the way. But certainly over the next several years, I think managing risk, avoiding losses is going to be kind of the name of the game.
And being a stock picker is going to become more important as well.
Yeah, there'll be areas of the market that will fare okay. and
Yeah.
it might be international markets, you know. So
Right.
you have to
That's
have
been
you have
happening,
to have a
right?
wide net. Yeah.
What about
Yeah.
China? Is it I know people say it's uninvestable, but they've been on fire. Are they untradeable in your work? Do you ever do anything in that stuff?
We do. You know, like I said, you have to, this type of environment, especially, you have to have an open mind about where you're going to go. And especially as believers in relative strength, whatever's working, we're going to go there. You know, we don't try not to have a bias towards or against anything. Don't have a perma position. Don't be a perma bear or bull in any market. So we do have an open mind. Recently, we were short China, looking at if you go to the
Yang.
just looking at the Shanghai Composite,
Okay.
which has had a nice bounce. Obviously, we were short, got short here in June as it challenged that 61 retracement. This was a great trade for us. Came down, tested those lows from the spring, covered our shorts there. It's had a nice run. We have not jumped onto any of the Chinese internet companies or anything like that. But yeah, you got to have an open mind about investment possibilities and investment opportunities, especially in a challenging environment when the macro trends, I think, are lower for the most part in most markets. But here's another one. Okay, so one of the best looking charts out there. Here's the hedged equity Japan fund, right? So how many funds do you guys own that are at all-time highs? Probably not that many, right?
Yeah.
So DXJ is the ticker symbol here. Broke out to all-time highs, you know, and this is actually a good spot. Pulled back to that the breakout area, that 23 retracement from those spring lows. Good spot to add some there, or if we do pull back further on that 65 level. So there's always opportunities out there, right, Dale?
All right, and you know what? This is your era now coming in. So what's the best way? You want to show your website, Dana?
Sure.
So you handle IRAs, you handle cash accounts, you handle all kinds of accounts. So
yeah,
perhaps people that have been, you know, the whole ball game changed with the Fed this year, have been passive and may be looking for a more active manager. Maybe people give you a call and talk to you about what you're doing.
Yeah, so sure. You know, we do our main business is managing money. A lot of retirement accounts, like you said. This is one area. There's another service that we started. It's called the Lion's Share. You can find it at lionsharepro.com. If you're a do-it-yourself trader, like most of your listeners probably are, we kind of share on a daily basis what we're looking at as money managers, what we're looking to invest in, and actually what moves we are making. So if you want to follow along what we're doing, if you don't want to, if you like doing it yourself, but want some guidance from a professional risk manager, you can find help here. But J Lyons Fund Management is the name of our registered investment advisory. So if you're looking for money management, you can find us there. If you want to email me, info@JLFMI, you can email me there, or dlyons@JLFMI. Be happy to start a dialogue for sure.
Okay, or on Twitter @JLyons Fund Management. James.
Yep.
You know, Dana, I want to wish you great holidays and an excellent 2023 ahead for you and your family and the people you work with, and want to thank you for your contributions to F.A.C.E over time.
Yeah, I appreciate it, Dale, and same to you and yours, and appreciate you having me on. It's always fun talking.
Good hunting, my trading warrior brother.
All right, take care, Dale.
Dana Lyons, everybody.
Merry Christmas.
Merry Christmas, buddy.
Yep.
Thank you, Dana. Everyone's thanking you. It's been a long time since seeing someone working on meta stock. Love it.
Yeah. I'm old school. All right,
hey,
take care, Dale.
My email address is AOL. How about that?
Oh, wow.
Can you top that? All right.
No.
Anyway, all right, Dana. Thank you, and
take care, brother.
All right. and everyone, you could join the team in 15 minutes on the morning edge. Don't just count your pips, count your blessings. Stay healthy, wear a mask indoors at stores and stuff. You don't want to feel like I do right now, I'm telling you. So enjoy the rest of your day. Get ready for a big week. Adios. You're welcome, Paul.